Yeah, it's certainly an interesting story, and so we're going to cover Boardwalk, but really what this segment is about is really more the concept of valuation expansion, and I'll get into the definition of that. But valuation expansion is it's a very important concept when it comes to financial research, stock research, particularly when you're using a GARP or growth at a reasonable price investment strategy. So we do talk about valuation or multiple expansion quite a bit. And I want to just basically clarify what it is and why it's important. So I'll just start off with a quick overview of Boardwalk here. Boardwalk is a Canadian REIT, real estate investment trust. They own and operate more than 200 multifamily residential properties. So these are apartment buildings, over 34,000 residential units. And their properties are primarily located in Alberta. It's around a 70% allocation to Alberta, around 10% to Saskatchewan, and then they also have properties in Ontario and Quebec as well. So the company's symbol is BEI.UN on the TSX. It trades today at just over $80 per unit, a market cap of about 4 billion, and it pays a relatively small yield for a REIT of 1.8%. But we recommended this company back in February of 2021. The recommendation price was just under $35. And really, I want to talk about the story and how this company has transitioned itself in the market from a stock that was trading at a significant discount to peers to one that now trades at a premium. So just taking a look at the share price since our original recommendation, as Ryan said, it's more than doubled over that period of time. So good share price performance in almost any market, but we also have to consider that since 2022, the REIT sector overall has been under a lot of pressure in the higher interest rate environment. So most REITs have not performed well in this environment, and Boardwalk has really bucked the trend there, really producing exceptional financial performance. But really what I want to talk about is the concept of valuation expansion. So we talk about valuation expansion a lot in our research. And what this essentially means is when we're looking at a company, we're always looking at profitable, cash flow positive businesses. And one way we're able to assess value is by looking at valuation ratios or multiples. So it might be like the price to earnings ratio or the price to cash flow ratio. So if a company is trading at $5 per share, has a $5 share price, they generate a dollar in earnings, say, you're basically paying $5 for every dollar of earnings of that stock. So that would be a price to earnings multiple of 5. Now, when the valuation expands, that means that for whatever reason, the market decides to value that company at a higher level. So, it may have a 5 or a 10 PE multiple currently, but that multiple can expand upwards to 12, 15, 20 times or beyond. And it can also contract if the market sees more risk. So generally, the valuation expansion is the result of increased investor confidence. And this can happen for a number of different reasons. There could be a headwind that a company was facing that is no longer an issue. It could be a company that is just not well known in the market, and its market profile improves over time. It could be an improvement in financial performance or just a recognition of the growth and the strong fundamentals that the company already has. Or it could be expectations for greater growth in the future or just lower perceived risk. So there's many different reasons why the market could decide to value a company more favorably. And as well, we could look at the opposite of these, and if in the event that the multiple contracts, that might be because of lower growth or higher perceived risk. But valuation expansion or contraction is really an important concept to understand when you're thinking about growth at a reasonable price, because GARP investors are essentially, they're not trying to find the cheapest companies on a valuation basis, but they are price sensitive, meaning that they do look at a company's value in the market relative to other companies and just relative to where the analyst assesses that company should be given the fundamentals. So really, when you're conducting research using a GARP strategy, a lot of what you're doing is you're looking for a company that's a good, solid growth stock, but where there's also potential for that valuation to expand over time. And in that case, you're getting the benefit of an expanding valuation, which moves the share price higher, and then also the earnings growth, which also would move the share price higher. So this is a very powerful concept. And when you're looking at companies, if you were to look at, say, a pure growth investing strategy, which is generally not as price sensitive, a lot of times the pure growth investor is looking for a company where the growth is extremely attractive, but the valuation may also be at a very high level, a premium to the market, and in some cases a substantial premium. But the higher the valuation already is, the bigger the premium that the company already has, the less likely you are to actually see an expansion, and then the more likely you are to see future growth really just coming down to the earnings growth of the company. So just as an example, you could take a company that has $1 in earnings per share. The market is currently valuing that stock at 10 times earnings. So 10 times PE times the dollar, that's a $10 share price for that company. But say over a period of time, that company were to grow its earnings per share by 50%. Now you have $1.50 in earnings per share. Assuming there's no change in the price to earnings multiple that the market is valuing the company at, you have a $15 share price. So 50% growth, exactly the same as the earnings per share growth. But in some cases, the market can decide to expand the valuation multiple, particularly if the company is coming out with better results than expected, or again, there's less perceived risk or more growth in its future. So in this example, the company's multiple maybe expands to 15 times. So now you're taking higher earnings, you're multiplying that by a higher price to earnings multiple. And the two work together to really give you much better leverage in terms of higher share price appreciation. So in this case, $1.50 earnings times the 15 PE would be a share price of $22.50. So more than 100% growth in the share price with the valuation expansion and with the earnings growth. Now, when we originally recommended Boardwalk back in February of 2021, what we saw was a very solid company in terms of growth. It was actually almost leading the peer group in terms of growth in its cash flow per unit, but it was trading at a significant discount. It was about 13 times FFO or cash flow. And then we compared this to what other Canadian apartment REITs were trading at that point in time. And on average, apartment REITs were trading at about 21 times cash flow. So we were looking at Boardwalk as a very financially strong company, growth oriented, up at the top of the peer group in terms of growth, but trading at a substantial discount to what the peer group average was at the time. So that was a lot of the basis of our original recommendation, is that we felt that investors were benefiting from the growth in the cash flow per unit, but also the potential valuation expansion. And this did happen. So we fast forward now to August of 2024, and now Boardwalk is trading at about 21 times cash flow, whereas the valuation multiple of the overall apartment REIT sector in Canada has actually contracted and has gone down to about 17 times. A lot of these companies are struggling a little more with higher interest rates. Growth has slowed, whereas Boardwalk has continued to grow at a very strong rate, even through this environment. So it's these two things working together, the growth in the cash flow and the valuation expansion, which have really led to Boardwalk's tremendous performance, particularly relative to its peer group. Now, why in the case of Boardwalk did that valuation multiple expand? Well, we've seen consistent growth in net operating income, including same property net operating income, which is up in the double digits right now, and growth in cash flow per unit. We have seen improved economic conditions in Alberta due partially to a recovery in the energy sector, but also high net immigration into Alberta. So there's high net immigration coming into the province, and what this is doing is putting upward pressure on rents in the province, which allows Boardwalk and other landlords to increase the rental rates. Now, just looking at Boardwalk's financials, we'll look at FFO or cash flow per unit from 2021 to 2024. We can see consistent growth here. And this actually accelerated in 2023 and is expected to be strong based on the company's guidance again in 2024. So, what is our take on Boardwalk? Well, we continue to see Boardwalk as a fundamentally very strong REIT, and it has an industry leading growth profile. So, it is one of the fastest growing REITs in Canada, not just in the apartment space, but just in the REIT sector overall. The company is facing some headwinds. There's debt refinancings this year, which will be likely at a higher rate. Well, they are at a higher rate. And then as well, inflationary cost pressures. So these are issues that are not necessarily specific to Boardwalk. They're really felt industry wide and even outside of the industry. But one of the things that I do want to note is now that the company is trading at a premium, we would have far lower expectations in terms of future valuation expansion. There really doesn't seem to be a lot of space for that valuation to move upwards without the company really becoming overvalued. Now, this could still happen conceivably if investors decided that they really like the REIT sector, or if Boardwalk's growth were to continue to improve as it has. But really, when we originally recommended it, when you're looking at a company at a steep discount that is a financially strong, growing company, you can have a more realistic expectation that the valuation will expand by a significant margin. Whereas in this case, I would really say that future share price or unit price growth of Boardwalk is really going to come down more to the growth in its cash flow per unit as opposed to any valuation expansion. So that's something to consider. But we do have a full update that we're putting together on Boardwalk. They just recently put out their Q2 results along with most of the other companies in the REIT sector. And we're actually putting together a comprehensive Canadian REIT report, which covers all 49 REITs in Canada: apartment, industrial, office, retail REITs, essentially covering all of them, looking at them all alongside each other, and then identifying our top recommendations. So Boardwalk will be in there with revised report and revised rating as well. Excellent. If I have any comments from you gentlemen, I'd be happy
I
to hear
love
them.
that one slide of the valuation expansion, like just showing, that's very, very representative for how, fundamentally businesses are valued. Um, so yeah, just tooting
Yeah,
your
and I
horn
mean,
there.
we talk about it a lot in terms of like, well, why do we tend to look for companies that are trading at a discount as opposed to a premium, or even just at a reasonable price? And it's because like you could have a great company that's growing its earnings 40-50% per year, right? And it's trading at it could be trading at a huge premium of 100 times earnings, right? Well, what happens if that growth declines to 25% a year? That's still incredible growth
Mhm.
relative to virtually any company in the market. But they're based on the valuation. The market is obviously expecting growth that is right at the top of the market. So you could still have a company growing in the double digits and see a contraction in the valuation because there's so much expectation baked in, and that 100 times price to earnings multiple can drop to 50, which is still a big premium. Um, but that's an example of where you can see a company that continues to put out strong performance, but actually has poor share price performance. Whereas where you are buying reasonably valued companies or undervalued companies that still have strong growth oriented businesses, there's just a far better likelihood that you're going to see the valuation expand as opposed to contract, assuming you pick them properly, of course.
Yeah, and that's really when you hear that phrase, the growth is priced in, that's what you're coming down to is when you're looking at those companies that are 100 times sales or something like that. That's what analysts, us or other analysts mean by the growth is priced in. It has to hit that high growth percentage, whatever it may be, year over year. And if not, then that multiple will contract. If it goes down to 20 times, there's 80% of your share price gone if all else stays equal.
Mm-hmm.
Yeah. And those are the cautionary tales. On the flip side, what you're looking for is a company that doesn't have the growth priced in, right? Like that you're forecasting 30% growth and it's trading at 10 times multiple, and there's a good balance sheet. And that's where you get, where you have Boardwalk, which is likely few years ago mispriced, trading at a discount to the sector, and then growing beyond the sector, and then gets a higher multiple over time. And that has happened with some of our greatest winners, like the Hammond Powers of the world, that traded at a massive discount to the overall markets, was growing well above over the long term a market rate of return, and eventually got rewarded, and then started growing above that rate, then got rewarded with a premium multiple. So you went to a discount to a premium and significant growth in the underlying EPS. I mean, that's how you get a true long-term winner in the market. And that's, that we've seen that. We saw that with Boyd, we saw it with Expel, Hammond Power, many of these companies. It's not only just their earnings powering it, but the multiple expansion, like Aaron talked about that.